Okay, so good morning and thank you for joining the Locality Planning Energy Holdings Limited investor webinar. I'm Jane Morgan and today I am joined by our non-executive chairman, Justin Pettit, and managing director and CEO, Damien Glanville. Today we'll be discussing the transformative restructuring exercise to focus on operations that create value and also answer any investor questions. So to ask a question throughout today's presentation, please use the Q&A function at the bottom of your screen. But Justin, I'll hand over to you.
Thanks, Jane, and welcome everybody to the webinar. We thought this would be a great opportunity to take questions, and we've got a few questions to go through, and in particular the announcement we made last week, where we're effectively, as an energy provider, asked all of our on-market customers to find an alternate provider based on the wholesale electricity market conditions, which Damien will talk a little bit about. But we've got some questions about all of our funding, the credit support coming back in from AEMO, and also the closing of our hedge book, which is now fully closed. We'll talk a little bit more about that and the timing of funding. And we can also report that over 80% of our on-market customers have now moved on to another provider, which is great. And we're looking forward to continuing to build our strata business. But maybe some of the listeners have heard Damien in the news on the 7:30 report, ABC, The Australian, talking about market conditions, but maybe talk a little bit about the wholesale market and what we think, and it's a bit of a disaster.
Yeah, well, there's no mixing words here. It's broken. It's failed. The energy market's failed. My opinion is the Australian energy market operator, AEMO, and their CEO has failed to manage the market. There's multiple reasons, with generation all off at the wrong time, not making generators behaviour, that they got away with it for a long time before they were reeled in. And really, this was a freight train coming into a station. You could see this coming a mile out, and I think around April is when we started to see what was happening and the behaviour happening. Then the month of May, with the lack of renewables in the market, just really blew it up a little bit further. And then a bit of a surprise, the end of May after the election, it actually got even worse when we thought it should have tapered away. But all of the bullshit in the market around Ukraine conflicts and gas shortages were all avoidable. But typical Australian fashion, we love to make things very difficult, and we succeeded in that. So the market was just poorly managed, poorly run. Generators were opportunistic, made a lot of money. In Queensland, the Palaszczuk government started the race, and then some of the gas generators topped it off with some of their behaviour. So, I could bore you all day long with my opinion and on how it and what I think, but ultimately this is going to take a lot of correction. These prices are the highest they've ever been in the history of the NAM. We're talking 3.5 times greater than the historic highs. It's going to hurt consumers, it's going to hurt business, it's killed competition. And the way we looked at it, we saw it unfolding, and we knew that the pressures to maintain a competitive advantage were just going to disappear pretty quickly. So for us was, we either lose our customers because they leave us because we're not competitive, or we make them leave and try and get value out of our financial positions. And that's what we did. One of our strategic goals was, when we look back in the start of April, end of March, was, if this was to happen, how can we do it and execute on our debt? We had to hold our nerve to do that. It was quite stressful, but ultimately that's what we wanted to achieve, to clean it up a bit. So we did, and we did what we needed to do to get to that point. In the end, it kicked on, and the market operator stepping in and shutting the market down for 9 days wasn't necessarily good for us at that stage, when we churned away customers, because there's opportunity lost there. But it's just greed on the table, I suppose. But it's a sad state of affairs, and I just don't see it fixing itself anytime soon. So energy markets, obviously the futures were down again this week, and then they bounced back up again. So, with the weather events going through, it's just another opportunity for generators to game the system. You can see in the last 2 days, the behaviour's changed back to where it was again, albeit not the vol moments, but consistent high pricing, which is the tough part. So I think the safest thing we could have done was exit the market and protect our core business, work with our stratas and making sure that they are looked after and maintain our service to them. So at the end of the day, energy prices will be high for some time. The capital required to play in the small market retail space is just absurd. The system's failed. The AER lacks leadership, AEMO lacks leadership, and as long as we're all trying to work under the regime, it was never going to succeed.
So we got a couple of questions come through which are on that genre. So the regulatory risk arising from asking customers to leave and the closure of the hedge book. So
So we had some very stern conversations with the regulator about that. They said it was not the right thing to do, it was not morally correct. And I said, well, your behavior is not morally correct either, but you're continuing to let the market implode. So basically they couldn't stop it. At the end of the day, the cash required to support our credit support was going up by the millions. And, I think we would have peaked at 7 times a customer's monthly invoice just in credit support. So that's it's not sane. And then when I spoke to the regulator and they said that they value energy at $110 a megawatt hour, and I said, well, it's averaging 400 for this quarter. I said, how do you get to that point? It was just very clear that they didn't agree, we didn't agree, and we needed to protect our business. So we did what we did. And obviously once I jumped first and pushed our direction, the whole market followed. So it just vindicated that we weren't completely insane.
Yeah.
So the regulator won't do anything about it, and closing a hedge book, well, that's just a financial asset. They can't touch that.
No, that's right. Yeah, it was. We were very swift in our move, and as everyone would have read in the media, there, Reamped and other retailers then followed suit. So we were glad that we were first off the block. Is there any? Do you want to answer this one? Government support for smaller retailers?
Not a chance.
No.
That's just, I don't think they know how to spell small retailers, to be honest. But I think the biggest issue will be how they divvy up the AEMO fees later on the month and how they support small business through that, small retailers. But no, not a chance.
Yeah. Will the market conditions make your renewable generation more profitable? Will we expand on this?
Yeah, arguably yes, because anything behind the meter means that you can make more money, because solar energy behind the meter or made is probably far it's 4 times cheaper than grid power at the moment, but it's only 12 months. This will recorrect itself back to some sort of normality. So it's an opportunistic win rather than a long-term one.
The timing of the hedge cash flows and AEMO credit support. Well, maybe I can handle that one. So we've fully closed before the AEMO closed the spot market. We were fortunate enough to close our hedge book. So we have certainty and locked in all of those cash inflows, which the majority come in the next financial year, this financial year, FY23. But there's a tail all the way out to December 24. So we were able to close that at $22.2 million, and we're in the throes at the moment of getting an advance on that cash flow. So that'll be something that the market can look forward to seeing here in the next few weeks. The AEMO credit support, of course, as we've gone from 21,000 on-market customers down to 4,000. And so as that load comes down, and that will wane off over the coming weeks. So by the end of July, we would like to see that the bulk of that $8 million is released and our MCL is adjusted. So again, it's just a function of load and customers, and they've come right off.
And also a function of the market operator not actually understanding this. It's never happened before, so they don't have the internal systems to actually release the cash. The way that they're processing the reduction in the MCL, which is our maximum credit support, is archaic and wrong, but there's nothing we can do to change it. We just have to be diligent and patient on that process.
Guys, there's actually a few questions coming through just on the strata market. So I might just try and combine them all through. So what's the plan for the strata market moving forward and building of that side of the business?
Yeah, well, it hasn't deviated from what we've always done in that space. The fact that we had retail was just the second part of the business. So our growth and service in that market is still as critical as ever. We're always looking for growth, and we've had recent successes in the last month or two as well, and acquiring customers. For us, it's really about making sure we can lower our cost to serve and increase the service we provide to our strata customers, really grow that hot water market, which is the long-term 10-year, quite strong revenue product, and then just really push that electricity embedded stuff. That's really where we are, and we're going to focus on existing embedded networks, existing hot water plants, and then just you know, fight a bit harder.
Yeah, and one of the questions around strata customer value. So if we start from the basis that our hedge book and our EMO credit support will wipe out our debt, so we'll have no debt, we'll put cash in the bank, and then we've had announced presentations where we've, in our opinion and based on past transactions, an embedded customer is worth anywhere from $800 to $1,600. So we use a rule of thumb around $1,000 a customer. You know, maybe a little higher depending on how long the contract is lasting for. But yeah, we've got over 28,000 embedded customers at the moment, so it gives you a little bit of an idea of the value. But that's certainly, you can look up our past presentation and see all that detail. With regards to operating costs, that's, you know, we have already started to cut those costs. You know, we don't need a lot of the personnel that we have for our on-market side of the business, and that has already begun. So I think you'll find by the end of July, we'll see a lot of cost savings there.
Yeah, one of the key things is that there is a roll-off for the retail book. It's not as simple as losing a customer. There is back-of-house work to process that out. So especially in the chasing of unpaid accounts, etc. So it's not just as easy as cutting off the business in half overnight. There is a wind-out process that we're working through.
Yeah, but you could say that half of the costs will come out of the, especially employee costs, will come out of the business through this change.
Again, gentlemen, quite a few questions just on BioHub. So how are things progressing at the Bundaberg BioHub, and when do we see stack mining being up and running?
Yep, so things are progressing on the BioHub. So they're building their renewable plant. Fortunately, the stack facility is a little behind, which is okay, because we all know that the Bitcoin price is a little down at the moment. But even down at these levels, sub 30,000 Australian dollars of Bitcoin, the GP is quite attractive, over 50% gross profit. And so yeah, it's dropped from, we originally modeled it at $56,000 Aussie a Bitcoin and was making 100% internal rate of return. That's dropped down to 50% with the current drop in the Bitcoin price. But again, that's an option that we have. If, you know, once Stack are up and running later in the year, we'll be able to review not only the performance of Stack, but also the general market, and decide if it's in the interest of all shareholders to exercise that option or not. But yeah, that $5 million investment in the BioHub should be added on to any valuation shareholders make of our embedded business.
After all, it is an embedded network.
Yeah, it is a large embedded network. Yeah.
There's just a few, oh, sorry, you jump in.
No, I was just going to go through some of these questions. No more bridging finance. So there's a question around bridging finance. Yeah, there's no more bridging finance required. Would we consider becoming a bigger infrastructure provider, for example, building our own solar farms locally? That's one area that we know a lot of our buildings and body corporates are really wanting renewable energy, and they're happy to commit to, you know, solar farms that are built inland, and happy to sign up for a long-term contract with those solar farms. So that's definitely something that we're looking at. We've announced it in the past. There's 2 solar farms, one north of Gympie and one also in Bundaberg, that we're been working with the same guys that are working on the BioHub. I don't know which question to go to next.
I know I'm going through them myself.
Well, I can give you an answer to Dominic's question. No, we will not be entering into the retail space again.
Yeah, no.
Is the next 4 or 5 years, especially with some large generation coming off, the risk for small retailers and the cash required to compete is just going to far exceed the return on investment. So yeah, look, it'd be very hard for small retailers without big bank balances or balance sheets to actually be successful. So no.
Yeah. So Duncan, we've answered his question. Can we talk about the revenue from the embedded business on a per customer basis?
It's the same as what it always has been. Customer prices have gone up, and some instances they've gone up materially, in some instances they haven't, depending on when their energy contract renewal was. It is what it is, but our margins are still the same. It just means some customers are paying more. That's just the function of the market. You know, it doesn't matter what market you operate in, you still, we're all price takers. The difference between ENs and retailers, we have load following hedges that don't expose us to the cash flow intensity.
Yeah. And the Steve's question about the cash flow position in the next 6 months and the 6 months following that. Well, you know, we've got an opportunity here to really trim down the business. And for FY23, obviously we'll make a profit during FY22 because of the closing of the hedges. But FY23, we'll be looking to be cash flow positive and take the opportunity to trim down the business, streamline our operational abilities, and you know, become a profitable company. M&A opportunities in the embedded network space. Yes, we're actually seeing a bit of stress on some of our competitors in the market at the moment, and there could be possibly some opportunities there in this market on some of the smaller providers.
Gentlemen, there's just one about the $5 million being loaned to the buyer already, or is there still some remaining?
That's all been fully funded. So that was fully funded back in April when our tranche 2 of the last capital raise came in. How is embedded networks business performing, and is there a strategy to realize? Look, the embedded network business has always performed very well. Even, you know, and I think it's important for us to outline how that side of the business is protected from these wholesale electricity market movements. So they're fixed priced contracts that we take for each of our buildings, primarily through Shell Energy. And yeah, the Shell are the front for those buildings, and they put up the credit support. And so where, you know, those buildings are unaffected by all this market turmoil. As far as a detailed guide on the timing of receipt of cash flows, yeah, we'll update. We'll put together. We're working on our FY23 budget at the moment, and yeah, we'll have. I think shareholders could see a retirement of the debt from BlackRock happening within the next month or so. So we're working on getting some funding for those future cash flows in order to repay BlackRock and move on and continue to grow the business.
And just so we can clarify that, so how that cash flow works is that we settle weekly with the value of that hedge. So as the market settles for the week, 5 weeks past that settlement week, we get paid out on that hedge on a weekly basis. So the value we locked it in for is the value we receive less what we paid for it.
I think that might potentially covered everything, gentlemen. I think perhaps just finally, so what can shareholders look forward to over the coming weeks?
Yep, I think the big thing will be repaying BlackRock back. So taking that hedge book cash flow and getting some forward cash and sorting out our debts with BlackRock. So that'll be something quite big for shareholders to look at. And then we'll put together a forecast on our embedded business, which organically is growing anyway. So we've got an excellent relationship, or excellent reputation in the market in the embedded space, and getting out of the on-market part of the business will refocus all of the company back into our embedded business, and so that we can service that even better than what we've been doing in the past. Is that yeah? So if there's any other questions, you know, please feel free to send them through to Jane or myself, and we're happy to answer any questions. Otherwise, you know, I just want to finish off that, you know, this market is unprecedented. You know, there are things happening in this market that have never happened before. It has been a very stressful time, and I must admit the pucker factor was high since July last year when Callide had an explosion and there was some volatility in the market. So it was really around Christmas time that we started looking at it very hard. And then April 1 was probably the big telltale for us, when the market moved totally the opposite direction of what it's done in the decades before. So we're very fortunate that we made swift decisions and got out and did what we did when we did it. And we've come out the other end, and we've got a company now that'll have zero debt, it'll have cash in the bank, it'll have a profitable embedded business that's growing and that's well known in the market. So shareholders can be rest assured that we've navigated through this really well and come out the other end. And now we've got a huge opportunity ahead of us to realize that value for shareholders.
Yes, and just further to that, so the contact details can be found at the bottom of our ASX releases, and a copy of today's presentation will be available to shareholders probably early next week. But if you do have any other further questions, please feel free to reach out.
Bye.
All right, thank you.